Good morning, friends. So we start today's session. So what I'm going to discuss today is how to determine residential status of an individual or a company in the context of international taxation. Now, this aspects of tax residency of an individual assumes importance from the point of view of the fact that one may be a citizen of any country, but the citizenship does not determine the residential status from the perspective of a liability to pay tax. The tax residency and the citizenship is not the one and same thing. So in order to determine the tax and why the determination of tax residency is important is because if one is tax residence of a particular country, then one is liable to pay tax on the global income in the country of its residence. While one may get the credit either of the foreign income or the foreign tax while determining the ultimate the tax to be paid in the country of its residence, but one has to offer necessarily the global income. So suppose you are a resident, Indian resident, and you have suppose traveled to UK, Europe, or say you are a chartered accountant or an advocate, just to keep this thing simple, and you travel across various nations and your income accrues in other countries also. For example, you provided some consultancy services in UK. So the source of the income is in UK. So wherever there is a source of income, the country of source always have a jurisdiction to tax you. So that right can never be taken away. So country of source will have the first right to taxation. But simultaneously, if you are a tax resident of a particular country, then in addition to the right of the country of source to tax, the right of the country of the residence also arises on the same income. Now you may ask me as to why one should pay tax in India as well as in US or UK or another country. So one will suffer double taxation of the same income. Now, in order to avoid this double taxation, India has entered into double taxation avoidance treaties with various countries. So if suppose you have rendered services in some other country or your income has accrued from any source. So suppose you are a company like say Larsen and Toubro, and you are obviously a country incorporated in India, a company incorporated in India. The Larsen and Toubro gets a project in say US to I mean construction of a bridge. So obviously, suppose the Larsen and Toubro gets a contract in the South Africa, it will have to offer its income accruing or arising in South Africa to taxation in South Africa. But at the same time, since Larsen and Toubro is a company incorporated in India, so it will have to offer its global income to tax in India also. But in accordance with the treaty between India and South Africa, the tax which is paid in South Africa will be allowed as a deduction in India. So this is the fundamental of this international taxation. Now, another fundamental question which arises is as to how you determine the residential status, the tax residency of an individual or a company. So I will first discuss how you determine the residential status of an individual, and then I go to the concept of how do you determine the residential status of a company. As far as an individual is concerned, I think almost all the countries have a rule for determination of residential status whether a citizen of that country or a citizen of some other country. So again, I must reiterate that in most of the countries, the rule for determination of tax residency is irrespective of the citizenship. It is always on the basis of number of days of stay in that country. For example, in India, if one becomes a tax resident, if you have stayed in India for more than 182 days in the previous year, or suppose 60 days in the previous year, and 365 days in 4 years previous to in 4 years immediately preceding the previous year. So in the previous year, you stay 60 days and 365 plus 60 in the year preceding the previous year. So 365 plus 60 in a total of 5 years, if your stay is there, you will be deemed to be the residents of the residents of India. But it might so happen that suppose there is a country which says that you will be resident of my state if your stay in my country exceeds say 120 days or 90 days, because every country is entitled to formulate or lay down the rules for determination of tax residency. So in that situation, one may become tax resident of more than one country. But in order to break the deadlock where one becomes the tax resident of say country X as well as country Y, there is Article 4 of the Double Taxation Avoidance Treaty. Usually it is the Article 4 only. You see, the double taxation avoidance agreements are formulated either on the basis of OECD guidelines or UN guidelines. So whichever may be the guideline, usually the rule or the article for determination of the residency or the residential status is Article 4 of the Double Taxation Avoidance Treaty. Now, Article 4 says that first of all, you determine the tax residency on the basis of the either domicile or residence or citizenship or place of management or place of incorporation or any other criteria. So every country can formulate the criteria for determination of tax residency according to their sovereign jurisdiction and whatever the political masters of that country deem fit. But if you happen to be the tax residents of more country, then the deadlock has to be broken, because you cannot be tax residents of two countries at the same time. You may earn income, you may become liable to pay tax in two countries at the same time, but you cannot be deemed to be the tax residents of two countries, and there has to be some mechanism through which you break that deadlock. Now, the rule number 1 is that you will be deemed to be the resident. Suppose there is a deadlock that you become tax resident of country X as well as Y. Then the first deadlock breaker is that you will be deemed to be resident of the country where you have a permanent home available. Now, the permanence of home cannot be simply that I am a owner. Suppose I have purchased a property in a particular country, then I can be said that I am a permanent. Permanence means, you see, various factors which are subjective in nature, and no definite rule can be laid down to determine that how that permanency will be determined. But usually you must have access to your home at all time continuously, and your travel must not be for a pleasure travel. For example, business travel or education travel or pleasure travel. It is usually a place where your center of vital interest is there. And how do you determine center of vital interest? Where your personal and economic interests are closer. For example, where your social and family relation, your political and other culture. So you see, there are various factors which can be considered, and one can always. This is something I'm reiterating that it is a very subjective thing. But one can say that, you see, look, my family stays here, and I travel to other places only for business or for pleasure or for travel. So my vital center of vital state is in interest is in country X. So that is how you determine your center of vital interest. Secondly, now suppose this cannot be determined, then what? Then you will deem to be resident of the state in which you have a habitual abode. Now, again, habitual abode is not defined in double taxation avoidance treaty, but as the judicial interpretation and the jurisprudence which has evolved over a period of time, and on the basis of OECD commentary and other, you see, material which are available, the factors which are looked into is the frequency, duration, and regularity of stay in a particular place. So if you are frequently visiting a particular place again and again, and your duration is longer than other places, and you have a regularity of stay, then these are the factors which can be considered to determine your habitual abode. And also, if all these things fail, then your nationality also can be a factor which can be looked into to determine your tax residency. But suppose all of these factors cannot determine your residential status, then both the countries, country X and country Y, will have to come together, and they'll have to settle the question between themselves by mutual agreement. So you will have to apply to the competent authorities, and they will determine. Now, in order to, if support, particularly in a situation like this, it is always advisable that one makes an application where one considers that one is a resident of, according to their own understanding, for a certificate of tax residency. And if you have a certificate of tax residency, then obviously, since it is flowing from a competent authority, it will be considered as a valid proof of your tax residency, and accordingly you will be taxed. So it is always advisable to procure a tax residency, but it is not the final factor. For example, you are a regular traveler and you don't obtain a certificate of tax residency, then does not mean that in the absence of tax residency, you can be considered a resident of any state, because your passport will speak louder than anything else. So passport can always tell your frequency, your duration, and your number of days of stay and all that, the purpose of visit and everything, your visa. These are the things which can always speak for themselves as to why you are traveling to which country for what. And more often than not, I think this deadlock, even if it is there, can be broken, even if it is subjective. So while apparently it looks very complex when I'm talking about it, but when you try to solve a real life example, then usually it is not so complex. So my second point of today's discussion is the residential status of a corporate. Now, how do you determine that? Now, you see, section 6.3, section 6, subsection 3, 6.3 does not mean 63, 6 subsection 3 of the Income Tax Act was amended in 2015, wherein it was held, wherein the amendment came into being, that if an Indian company or a foreign company, the residential status will be determined on the basis of place of effective management. So one may be a company may be incorporated in, say, Dubai. But if the place of effective management is in India, then it will be considered to be an Indian company. Now, why this came into being? Because you see, smart individual, in order to park their money abroad, they started incorporating company in tax haven countries where you see there is no income tax. For example, in Dubai, there is no income tax. So you incorporate in a your company in a tax haven like that, where you pay some minimum you see annual fees to the government of that particular country to manage and run your company. You just have a paper company. The the board of director are there only for the namesake. You make somebody a director in your company who is a local guy, but he is there only for the namesake. The company is only a mode of parking the money which is accruing or arising elsewhere. Maybe you are parking your Indian income over there, or maybe you are parking your global income in that Dubai so that it does not get taxed in India. So it used to be a device of avoidance of tax. So the Income Tax Act was amended in 2015, which became effective from 1st April 2016. That means financial year 16-17 and assessment year 17-18. So there this tool to avoid the taxation was totally shut down, and the government brought an amendment whereby the place of effective management became the key word now, which is also called POEM, POEM. So place of effective management is an internationally recognized test for determination of residence of a company, wherever it is incorporated. So the country of incorporation is immaterial. Just like I said that the citizenship is immaterial. So now in the context of companies also, earlier the country of incorporation assumed the most important significant factor to determine that residential status. But now it is the place of effective management. Earlier also the concept was control and management. Now this was very easy to avoid because by shifting insignificant or isolated control and management outside India, the company used to say that, look, my control and management is outside India. So now the word control and management has been replaced by place of effective management. So wherever there is a place of effective management, as far as the India is concerned, it will be deemed to be tax resident of that country. Now in 2017, prior to that also a circular came, but I think I would like to refer to circular number 6 of 2017, which has laid down the detailed guideline or the guiding principle for determination of place of effective management for determination of residential status of a company. Now there are four variety of tests. No test is final and determinative. Again, it is all very subjective. And one cannot say that if you apply this test, then one can say for sure that this is the thing, this is the end of the matter. But nevertheless, I will discuss all of them one by one. One test is active business. So if you're active business outside India. So this active business outside India means if the passive income of a company is not more than 50% outside India, then it will be said to be that it can be said that the place of effective management is outside India. So what company does is that passive income means, you see, there is no real income. Passive income has also been defined here in this circular, which says that it is an income aggregate of income from transaction where both the purchase and sale of the goods is from its associated enterprise, and income by way of royalty, dividend, capital gain, interest, or rental income. So what will a paper company do? It will enter into transaction with its own associated enterprise. So there is a company Y in UK, there is company X in India, there is company Z in Saudi Arabia, and this company A, which is incorporated in Dubai. All that it does is that it enters into transaction with its associated enterprises. It is not dealing with the outside world. It is dealing within the family. So by doing that, it is quite obvious that you are transferring the income in other jurisdiction to this particular jurisdiction, which is a tax haven. So it is a passive income. So if the income of a particular company in a foreign jurisdiction is all that is passive income, that means it is dealing only with its family companies. That means it is only for the purpose of tax avoidance. The head is sitting in India and it is transferring its income, global income, to some tax haven. So that will be treated as a tax resident of India. Similarly, if there is a passive income in the form of royalty, dividend, capital gain, interest, and rental income, then also it can be said, so you have invested a property in UK, or you have a shares of Indian company, and it has opened a subsidiary company in Dubai, or say British Virginia Island, and by investing all over the country, say the company like say it's a very reputed company also, say Reliance. It is a lot of money, so invests all over the world. And in order to earn that investment, it opens a company in a tax haven where all that passive income is going. So the holding company, which is the owner of all those assets, real owner, that real owner will not be able to, because the money will not flow to the real owner. It will flow to the subsidiary, which is sitting in some tax haven. So the place of effective management, while the place of effective management in India, so it will be deemed to be a tax resident of India. Similarly, there are other criteria also, like more than 50% of the total assets are situated in India, or more than 50% of employees of that foreign company is situated in India, or more than 50% of the payroll expenses are in India. So if all these criteria are satisfied, one can reach a conclusion that the place of effective management is in India. Now, another aspect which can be looked into for determination is where the effective decisions are taken, where the senior management resides. Senior management of a company means where those who formulates the key strategies and policies for the company, not the operational level employees. Those management, for example, managing director, chief executive officer, CFO, or CEO. So these kind of people who are the key managerial personnel, and those who formulate how the company will operate, takes the key decisions, that will be a place which will be considered to be the place of effective management if these are the people who are taking the key decisions. Sometimes where the board of director, all these managerial people, where they are tax resident, that can also be a factor to determine where the place of effective management is there. But one clarification which is there is that it is not necessary that the residence of the shareholder will be looked into, provided there is a division between the shareholder and the management of the company. There are some family managed company where the shareholder exercises all the rights of the management. In those kind of companies, obviously the place of residence of the shareholders can also be looked into. But usually the shareholders in a big corporate and the management are different, and therefore you look into where the key managerial people are, or where the key decisions are being taken. One of the other principles which can also be taken into account for determining the place of effective management is where is regularly the board meeting taking place, or where you see, it might be possible that the board of directors have delegated most of its authority to a committee, and that committee is sitting in a particular jurisdiction. Then if that committee, the board of directors delegated all its authority to a particular executive committee, then the place of that executive committee can also be a factor to look into and decide where the place of effective management is. Then the head office of the company can also be a factor to decide the place of effective management. Now, as I have already said, that the day-to-day operational decisions are not material to decide the place of effective management. Operational decisions means day-to-day business operations or activities of the company, where the broader policies of the companies are not decided. The strategy of the company is not decided. They are only implemented. So that has to be ignored to decide the place of effective management. And also, the circular says that the holding, the foreign holding or the permanent establishment, all these factors will not necessarily decide the place of effective management. Now, again, you see, the circular says that these are all principles, general principle for determination of place of effective for guidance only, and no single principle will be decisive in itself. The principles are not to be seen with reference to any particular moment in time, rather activities performed over a period of time, and the place of effective management may change from year to year. So in 1 year, a company may be tax resident of one country, and in another year, it may be tax resident of another country also. That is also very much possible under the present set of guidelines and law. Another important factor is that there is another circular which says, which is circular number 8 of 2017, dated 23/2/17, which says that all these principles, guidelines, and section 3 has no application if the turnover or the gross receipt is less than 50 crore in a financial year. So, friends, I have given the broad, you see, I've discussed the broad concept of the determination of residential status in the context of international taxation. If anybody has any query, then I would like, will be very happy to deal with them. Thank you very much.
Sir, may I ask a question?
Yes, yes.
If a foreign citizen who originally happens to be a resident or citizen of India, currently a citizen of, say, another country, maybe Australia, he has got some right in ancestral property in India. And finally, that property is disposed, and he happens to be having capital gains out of that property.
Correct.
So the capital gain benefits which accrue under Section 54 or anything else, will they be accruing to him also as a normal resident?
Yes, if suppose he is a now suppose he has shifted to Australia, he is now a tax resident of Australia.
Yes, yes.
Whereas he continues to hold some ancestral property in India, and it is sold and he earns some capital gain out of it.
Yes, sir.
So that capital gain will be taxable in India.
Yes, sir.
So whatever is the rate of taxation or whatever benefits accrues to him under the heading computation of capital gain, that will accrue to him.
Okay.
Whatever accrues to a non-resident, not to a resident.
Okay.
So that will accrue to him, but whatever taxes are paid by him in India will be adjusted against his liability to pay tax in Australia. For example, he ends up paying 20% tax as a long-term capital gain in India.
Okay, sir.
And the rate of tax in Australia is 30%.
Okay.
Then this 20%, the whole, suppose 1 crore is his income, capital gain income in India. So
Okay.
this 1 crore will be offered for taxation in Australia also.
Because of
In
his
Australia,
residence there.
listen to me
Oh,
one
sorry.
second.
Sorry, sir. Sorry.
So 1 crore will be taxed in Australia also. Rate of tax, I am presuming, is 30%.
Okay.
So 30 lakh is his tax liability in Australia.
Yeah.
Now this 30 lakh, now is in India, his tax liability, which he has already paid, is 20 lakh. So this 20 lakh will be deducted from his tax liability in Australia, and he will be paying to the Australian government only 10 lakh rupees.
Okay.
Consider a reverse scenario where the rate of tax in Australia is say only 10%.
Okay.
Then this 20% tax which he has paid in India, it will be adjusted only to the extent of 10%, because the
Okay.
Australian government will never give a refund of the tax which is paid in India.
Yeah. Yeah.
So you cannot have a situation where you pay tax in some foreign jurisdiction and you claim the refund of the tax in the country of your residence.
Okay.
Sir, one
So,
more question, please.
so, sir,
Yes.
sorry. In such case, like whatever amount of tax is left over, like we discussed the situation just now. So, will he be able to claim the refund of that tax in India?
No, no. In India, too, he has to pay the tax. He will be getting the set off in the country of residence, that is Australia. In your example, you said he is a tax resident of Australia, so he will get a set off in Australia.
Agreed, sir. Like
No,
he
but
will,
like you mean to say this 20 lakh extra, I mean, the tax rate in the country of residence is 10 lakh rupees. So whether he will get 10 lakh refund in India?
yes, yes, yes.
No, no, that he will not get.
He will not get any refund.
No, no.
Sir, the rule is that whatever is minimum, suppose if you have paid tax in out of India, more tax you have paid out of India, and as per Indian law, the tax is less, then you will
Correct.
get the less, but the less amount will be adjusted.
Correct, correct.
Refund
You are
amount is
right.
there. Sir,
Absolutely, absolutely.
one question is that last 2 years it has been observed by the government, and I think they have also brought some changes in the legislation.
Right.
Just you have told that Dubai is zero tax rate.
Huh.
So people live in Dubai for they make their status resident in Dubai, not in India. So
Right.
their Dubai income is not charged to tax in India, or and I mean only Indian income will be charged to tax in India, not Dubai income.
Not
Because
Dubai
and
income.
there are some changes. The government says that if there is a zero tax, if you are resident of zero tax residency, your that country income is also chargeable to tax in India. I'm correct, sir?
No, yeah, that is another aspect. That is another aspect of Section 6, which they have brought into. So today, you see, I did not want to go into that larger discussion that I will discuss in some other session. You are right. So that since last 2 years, that amendment has been brought into, as to look into as to what is the effective tax you are paying in other countries. So those globetrotters who you see become the global citizen, or say only for shifting their tax liability, they go elsewhere. So in order to catch hold of this kind of people, this rule has been brought. So you are absolutely correct on that.
Another question is, suppose I am a non-resident and my PAN is also say that I'm non-resident, but my passport is say of US. So will I be treated as foreign resident?
No, you see, neither your PAN nor your passport, which country you are passport holder of, determines your tax residency. It is always determined on the basis of number of days of stay in a particular country.
But in every year we have to make a
Every year
separate
it
test.
will change.
Oh,
It will be
thank you,
decided year to year.
thank you, sir.
Uh,
Sir, through this forum, we may request the organizer to take session on this also, zero tax residency, because it's a now hot up matter, please. Thank you.
No, I will do that in next session, maybe zero tax residency, and then other concept of permanent establishment. Next session or some other session, I will definitely take up.
Thank you, sir. Thank you. Obliged.
Thank you. Thank you. Thank you. So I think there are no more questions. So then thank you very much. So I will conclude today's session. Thank you very
Thank you,
much.
sir. It was very insightful.
Thanks a lot for joining. Thanks a lot.
Thank you, sir.
Please keep asking questions whenever there is a topic. I mean, you can keep some questions ready with you to ask me. And I'll be very happy to interact with all of you. I don't want it to be a one-way traffic where I just give a lecture and there's no interaction.
Thank you, sir. Thank you.
Thank you, sir.
Take care
Thank you.
next time, sir.
Thank you. Thank you.